Hi there, Miss Barber here. This lesson is titled Income Tax. A personal income tax is a type of tax that governments impose on income generated by businesses and individuals within their jurisdiction to fund public services, pay government obligations, and provide goods for citizens. A personal income tax is levied on an individual's wages, salaries, and other types of income. The average American pays over $10,000 per year in income taxes. Yes, it's important to pay Uncle Sam what you owe, but not a penny more. In this lesson, you will learn how federal income taxes are determined and calculate so that you pay no more than you must. The role of tax payment planning is an essential part of your personal finance. U.S. federal income tax. Let's begin with some definitions. 1. Gross income or total income includes income from wages, tips, interests or dividends from investments, unemployment compensation, profits from a business, rental income, and even game show winnings. See the IRS definition for a more complete description. Adjusted gross income is determined by subtracting allowable amounts called adjustments from the gross income. Again, see the IRS definition for a more complete definition. The adjusted gross income is equal to the gross income minus the adjustments. And finally, taxable income. Taxable income is the adjusted gross income less exemptions and deductions. A tax deduction lowers a person's tax liability. An exemption is a deduction allowed by law to reduce the amount of income taxed. For a detailed description, see exemption definition at Investopedia. We compute taxable income as adjusted gross income minus the sum of exemptions and deductions. Example, a single woman earned wages of $77,500, received $570 in interest from a savings account, and contributed $3,600 to a tax-deferred retirement plan. The interest on her home mortgage was $78.75. She paid $4,800 in property taxes, and because she resides in Texas, no state income tax. She also contributed $3,500 to an IRS-approved charity. Use the 2018 marginal tax rates and the 2018 marginal tax rates of the 2017 Tax Cuts and Jobs Act, both provided here, to compute each of the following. A. Determine the woman's gross income. Your gross income is everything you earned. In her case, that's the $77,500 plus the $570 for a total of $78,070. B. Determine the woman's adjusted gross income. Her adjusted gross income is her gross income minus the adjustments. Her gross income we computed in Part A as $78,070, and the adjustment is the $3,600 she put in a tax-deferred retirement plan. So her adjusted gross income is $74,470. Part C. Determine the woman's taxable income. Compute it according to the 2018 marginal tax rate prior to the tax cut. So let's begin this with a standard deduction. The personal exemption for a single person is $4,150. The standard deduction is $6,500, And your taxable income is computed as the adjusted gross income minus the sum of your exemptions and deductions, which would be the $74,470 minus the personal exemption of $4,150 plus the standard deduction of $6,500, which lowers her taxable income to $63,820. Let's do this with itemized deductions. First, we compute the sum of her deductions. She has the $7,875, the $4,800, and the $3,500 for a sum total of $16,175. And her taxable income is her adjusted income, which we computed as $74,470 minus she still gets that personal exemption and the sum of her deduction, which lowers her taxable income to $54,145. Let's compute it again, but with the tax cut. With the tax cut, first thing we notice, there is no personal exemption. None. Let's continue. The standard deduction, though, is $12,000, so we'll go ahead and mark that, and then we will compute. The taxable income is the adjusted gross income minus her standard deduction. That's the $74,470 minus $12,000, so her taxable income under the tax cut with the standard deduction is $62,470. Let's do this with the itemized deductions with the tax cut. Let's sum up her deductions, which shouldn't change. They're the $7,875, the $4,800 plus $35, which is still $16,175. The taxable income, though, without a personal exemption. So you still have the $74,470 minus the sum of the deduction, $16,175, is equal to $58,295. We see that the taxable income is smallest for this woman with itemized deductions under the prior code. That's before the tax cut. We've got a few more definitions. Tax credit. A tax credit reduces your total tax bill by the full credit amount. A tax deduction reduces your taxable income by the deduction amount, and your income tax is your computed tax minus any tax credits you may have. Example, calculate the federal income tax owed by a single woman with no dependents, a tax credit of $500 with a taxable income of Part A, $54,145 according to the 2018 marginal tax rates prior to the 2017 Tax Cut and Jobs Act. We begin this by looking at that particular marginal tax rate. Keep in mind that this tax rate was never used. Her taxable income of $54,145 places her in the 25% tax bracket. She owes 10% on the first $9,525 of her taxable income, 15% on her taxable income between $9,525 and $38,700, and 25% on her taxable income above $38,700. So we write 0.10 times $9,525, 0.15, that's 15%, times 38,700 minus 95.25, and finally 25%, 0.25, times her income of $54,145 minus the $38,700. Continuing, we still have 10% on the first $9,525. We have done the subtraction, and so 38,700 minus 9,525 is $29,175, and finally in the 25% tax bracket, the difference of $54,145 and $38,700 is $15,445. Doing the multiplication, you get $952.50. In the 15% bracket, her tax is $4,376.25. And finally, in the 25% bracket, her tax will be $3,861.25. Add those together, and the sum is $9,190.
To get your income tax bill,
we take the tax computation, which we just got to be $9,190, and subtract the tax credit, which would be $9,190 minus the $500 tax credit. The difference is $8,690. So she owes $8,690 in federal income tax on the tax tables prior to the tax cut. Now Part B, $58,295 according to the 2018 marginal tax rates after the 2017 tax cut. So for our solution, we begin by looking at that tax cut tax table. This is the one that was in effect. Her taxable income of $58,295 places her in the 22% tax bracket. She owes 10% on the first $9,525, 12% on her taxable income between $9,525 and $38,700, and 22% on her taxable income above $38,700. So we have 0.10 times 95.25, add it to 0.12 times the difference of 38,700 minus 95.25, add it to 0.22 times the difference of 58,295 minus 38,700. That will take us to 0.10 times 95.25, 0.12 times the difference, which is 29,175, and 0.22 times the difference, which is 19,595. That lets us add together $952.50 plus 12% of 29,175 is 3,501, and 22% of 19,595 is $4,310.90. The sum of which is $8,764.40. We compute our income tax as the tax computation minus tax credits. Our tax computation is the $87.64. We subtract the tax credits, and so the difference is $82.64.40. She owes $8,264.40 federal income tax with the new tax code. We see that she owes less federal income tax under the new tax code, even with a higher calculated taxable income. Example, Sullivan is in the 25% tax bracket. A, how much does a $1,000 tax credit save him? Our solution, whether or not he itemizes. The entire $1,000 tax credit is deducted from his tax bill and saves or credits him the entire $1,000. Part B, how much does a $1,000 tax deduction save him? Our solution, for the 25% tax bracket, the best that a $1,000 deduction will save him is $250, and only if he itemizes his deductions. However, if his itemized deductions are less than the standard deductions, his charity contribution saves him nothing. Social Security and Medicare, otherwise known as FICA. FICA stands for Federal Insurance Contributions Act. Let's get some terms. Definitions, FICA. FICA are taxes collected and used for Social Security and Medicare benefits. Social Security provides payments to eligible retirees, people with health issues, eligible dependents of deceased persons, and disabled citizens. Medicare provides health care coverage mostly to Americans 65 and older. The 2018 rates, according to USI Chernoff Diamond, are presented in this table. Let's note 6.2% for both the employee and the employer rates for the first $128,400, and for self-employment it's 12.4% because you pay for it yourself. You're the employee and the employer. For Medicare, it's 1.45% on the first $200,000 of income for both the employee and the employer, and if you're self-employed, you paid both parts, which would be 2.9%. For Medicare tax for income in excess of, and if you make more than $200,000, the employee contributes 0.9% as well as the employer, and if you're self-employed, you do both. Keep in mind that this is the current rates.
The marginal rates and the FICA tax tables in your textbook are several years old. Even so, use the old ones to solve the problems in MyLabs.
Example, in 2018, Taryn earned $42,000 in wages and tips as a social media coordinator. He is single and takes the standard deduction. Use the 2018 effective marginal tax rates. Part A, calculate his FICA taxes and his total tax bill, including the marginal taxes. Let's begin by computing the FICA tax, which is the sum of the Social Security tax and the Medicare tax, which is 6.2% plus 1.45%. The sum of 6.2 and 1.45 gives us 7.65, and we multiply that by his income. That times 42,000 is $3,213. Now we need to compute his taxable income, which is his adjusted income minus the one standard deduction. His adjusted income is $42,000, and in the 2018 marginal tax rates, he gets a standard deduction of $12,000, the difference of which is $30,000. Let's compute the tax. His income is 10% up to the first $9,525 and 12% on his remaining income. That would mean 10% times 9,525 and 12% times the difference of 30,000 minus 9,525. 10% of 9,525 is $952.50, and we still need to multiply by 12% of the difference of $30,000 minus $95.25 is $20,475. That gives us $952.50 plus the $24.57. So his income tax is $3409.50 and his FICA tax is $3213. We take Taryn's income tax of $3409.50, add it to the FICA tax, and the result is $6622.50. What is his overall tax rate on his gross income, including both the FICA and the income tax? Well, the solution is you take his total tax, which was $6622.50, and divide it by his gross income, which was $42,000. In your calculator, compute it, and you get approximately 0.157679. So his total tax rate is about 15.8%. Working students and taxes. Example, you get a part-time job on campus to make ends meet for your expenses. Your job pays $10 an hour and you work 20 hours per week. Your employer withholds 10% of your gross pay for federal taxes, 7.65% for FICA taxes, that's Social Security tax and Medicare tax, and because you work in Texas,
No state income tax.
A, what is your weekly gross pay? Well, that would be your pay, which is $10, times the number of hours you work. So your gross pay is $200. How much is withheld per week for your federal taxes? Your solution, it's going to be 10% of your gross pay. So 0.10 times $200 of your gross income, that would be $20. C, how much is withheld per week for your FICA taxes? You take the 0.0765 for your FICA taxes, multiply it to your $200, and $15.30 is what that's equal to. That's how much is also withheld from your paycheck. Part D, how much is withheld per week
For state income taxes. Solution, $0. You live and work in Texas, and Texas has no state income tax. Part E.
What is your weekly net pay? That's how much do you bring home? Well, you got $200 of your gross income minus your federal taxes and your FICA taxes, so you bring home $164.70. What percentage of your gross pay is withheld for taxes? Well, the amount withheld divided by gross. The amount withheld was $35.30. Your gross pay is $200, and use your calculator to compute. That's 0.1765. 17.65% is withheld for taxes.